Good morning, Jags. This is Fahad. Today is Friday, October 16th. Let's get started. The chart that's in front of you is DXCOM, symbol DXCM. If you look closely, this chart hasn't done much for about 6 months now. It has been consolidating in a very tight range. The $375 level remains a critical support for the stock right over here. It has bounced off that level multiple times. And on the upside, the natural resistance tends to be around $450 per share. Currently, this stock is near the support level, and I believe that this is presenting a buying opportunity. Here is another technical view on the stock, purely looking at from downtrending resistance standpoint. Multiple times it has come up to this resistance and it has failed to sustain a momentum, but the volume on sell-offs have been very, very light. I believe this is largely a function of just basically continued consolidation pattern. I want to see if this thing will start to break out from through $400 to $405 per share. If it does, and if it holds there for at least a couple days, next thing is going to be $430 as my first target, because that's where the major VOP resistance comes into play. So from 405 to 430, that's about $25 there. And I want to see if I can capture that move on the breakout by trading call options. So that's the technical picture on Dexcom. Also, just a reminder that if you go to the activity tracker in Jaguar Analytics, you will see that on September 21st, we pointed out there was a call ratio spread that was bought. Specifically, somebody bought 2,400 of the November 400 calls for $30.50, and they sold twice as many, or 4,800 of the November 450 calls for $11.80 credit. A nice, easy way to basically make a bet for the upside. And that bull still remains in the open interest. If you go to Dexcom option chain, you can see it right over here, the open interest, the 400 and the 450 strike. Now, the reason why I bring this up is because the news flow on Dexcom has been rather very, very quiet for quite some time. First of all, here's a two-part bull case. One is short-term and then one a long-term. Short-term, the reason why this stock has been consolidating for the past several months is because, and you will notice that back here on July 13, there was a big, large sell-off as well. That's because the new competitive threat has emerged from Abbott Labs, which launched the Freestyle Libra in July, and I issued a podcast at the time in Spotify that you can listen to, talking about how this will become a very competitive product in the market. But at the same time, I've also mentioned many times previously that there is all the reasons to believe that the CGM space is so big that both of these companies for many more years to come can continue to grow into what is still very, very low penetrated markets. Nevertheless, though, Dexcom, ever since that Abbott launched that product, Dexcom has gone into a consolidation phase. And I believe that this will now gradually get resolved with a breakout. This morning, Chronicle covered this in the first read. There is a note out, bullish note out from Citigroup, calling it the positive catalyst watch. And in this case, based on a survey of 79 endocrinologists, they're saying that it indicates that the market opportunity for continuous glucose monitoring, or CGM, and pump technology has just begun. Physician volumes have recovered from the pandemic. Continuous glucose monitoring adoption is accelerating across both type 1 and type 2 diabetes, and more patients are using insulin pumps in conjunctions with CGMs. The analyst basically maintains a buy rating on all of these names that we have liked so much, including Dexcom, Abbott Labs, Insulet, symbol PODD, as well as our favorite of all, which is Tandem Diabetes. Let's see if the Citigroup note out today is going to be sufficient to push this stock into a breakout territory through $405 VOP resistance. One last thing on the long-term side of the bull case, I would like to point out that why I'm not concerned about a competitive threat from Abbott Labs. If you look at the core market for CGM just in the United States, it is estimated to be about $4 to $5 billion. There are approximately 3.2 million patients today that pay about $4 per day. Now, compare that to the actual sales that is generated by Dexcom and Abbott Labs combined, and that's only $2 billion. So there is room, and that's what I mean, that the penetration is less than 50% right now. It's more like 35 to 40% for the entire market. There are few experts who doubt that this market will reach close to full penetration, and the penetration is lining up, while new products like G7 and Libra 3 would help bring even more patients onto CGM. Even if we believe that Abbott is going to gain some incremental market share in the United States, there's reason to believe that there's plenty of new revenue coming up for grabs for Dexcom to see healthy rate of growth for quite some time to come, in my personal view. So that's the United States market. Now, if we look at outside of the United States core market, right now, today, it's only 5 million patients today. That's it, 5 million patients today between both type 1 and type 2 diabetes combined. The world is big. There's a massive population that's out there. Penetration in this market is nearly non-existent at this point. It is easy to assume, if you look at the street models, it is easy to assume that as these companies gradually launch into various countries, particularly in Europe and other developed nations, within the next 2 years or so, that market will increase by 7 times, from 5 million patients today to 35 million patients, particularly more countries joining, with approval coming for CGM devices just over the next couple of years. And then if we apply, in the United States, the patient pays $4 per day. But even if we apply a low average selling price of only $1 per day for the outside of the United States core market, that equates to $10 billion in revenues per year. And right now, you might want to take a note that today Dexcom generates less than $400 million in revenues from outside of the United States. And if you include Freestyle Libre from Abbott too, Abbott generates 1.7 billion. So the penetration in outside of the world, outside the United States, is less than 2.3 billion right now. And the G7 device as well as the G6 device, both are pushing into many new territories internationally. So there's a very large opportunity here. Don't discount that. And I believe both of these companies will continue to perform very well for many more quarters and years to come. Let's see if this thing takes out 405. If it does, I think you get to $430 to $450 per share rather easily. That's it from me. Jay.
Morning, Fahad. So today, taking a look at Hostess brands, symbol TWNK. In yesterday's session, we did highlight activity out in the December 15 calls. And then per first read today, we can see that open interest jumped from 0 to just over 7,300. So now looking back at their Q2 call, we can see that net revenue growth was up 11.7%. Total point of sales were up 7.4%, and then for the Hostess products, point of sales were up 9.2%. In addition, they talked about how household buying increased 10%. Hostess trip dollar growth in units per household were also up versus the prior year. And importantly, repeat customers or repeat purchases were also up. The one blemish that happened in Q2, I would say, would be a continuation of the decline in single serve sales. So if you were to go to a convenience store, on the shelf, you'd see like a 2-pack of Twinkies or a 2-pack of cupcakes. This would be your single serve item versus going to a Walmart and picking up, a 10-pack of cupcakes, for example. So what you saw is really starting in Q1, single serve sales were down 10 to 15%, but that improved in Q2 to down 5.5, and then from July to date, you're essentially flat. So you are seeing an improvement there. Another topic was the recent acquisition of Vortman, who sells premium branded wafers and specialty cookies. They acquired that company back in December of 2019 for $320 million. And essentially the transition, the integration is ahead of plan right now. Now they did note that there was some pull forward in EBITDA from the second half into Q2, but Q3, Q4 profitability should be relatively in line with Q2 levels. And then lastly, they did mention that Q3 is their largest selling period. So what they were planning on doing is they made the decision to delay the rollout of certain new items, and instead they were going to prioritize core growth. But they'll be ready to launch new products when the time is right. Morgan Stanley was out with a note in mid to late August, essentially kind of reiterating that point, but also highlighting that they see an opportunity for the company to benefit from consumers bringing Halloween to the home this year, obviously because of COVID. They say pre-COVID, Hostess Brands was already seeing a trend of increasing Halloween parties versus traditional trick-or-treat, which positively impacts the company as it benefits from in-home entertainment and is not reliant on the knock on the door activity. Given social distancing restraints, Hostess believes the pandemic will accelerate this trend and should act as a tailwind for the company, given how Hostess products fit in the at-home needs state.
Very interesting. The trends that basically is telling that the trends are actually quite positive, continuing from the Q2 to Q3 period and rather accelerating in certain spots for the company. Chart looks absolutely fantastic. Naturally, as you can tell, my first target would be more upside follow through with this air pocket that's open up to $14 per share. Stock closed at $13.33 yesterday. We'll see if we're going to see a little pause and consolidation there first near 14 because the RSI is starting to get a little bit overbought. Now it's 70. But the way these option market is betting, now these are low dollars, right? So sure, yeah. Just to point this out, but nevertheless, the open interest was 0 before yesterday or before today in these December 15 calls, and now it has jumped to over 7,300. All of it was bought yesterday. And so, I mean, this is very, very small, low delta trades with only 20 to 30 cents per contract. Nevertheless, this points out the $15 is right here. And naturally, they're expecting a strong holiday season, strong trick-or-treat season, and all of that. And then potential move all the way up to new 52-week high, 15 plus. And so let's see and I love the patterns technically. Anytime when the stock is breaking out on high volume, that tells you that there is thrust behind it. And that's the case over here with this breakout in the last couple of days has been on rather rising volume. So that gets my interest as well. I think it's worth the shot because I could easily see another 5 to 10% in stock from here. I don't know if it will make it all the way to 15, but I think momentum is quite strong to capture some of this move in short term. So I like it. Good stuff. Hey, Chronicle. Before I ask you what you have for today, but another price hike by Celanese, right? They increased their selling prices for their engineered material products by another 10%.
Yeah, it seems like they're doing it every other week.
Yeah, and this has been my message for quite some time now regarding all specialty chemical companies, as I discussed earlier this week as well in chat room with clients, that there is a 87% correlation between the US producer price index and the end prices that specialty chemical companies charge. And so when PPI is rising, which is what we saw last time with September PPI up 0.4% versus estimate of 0.2%, that means it's only a matter of time before you're going to see more and more news from specialty chemical companies about raising prices. So as covered in the first read by Chronicle, you can see right over here, in another price announcement, the company will increase prices by up to 10% on its engineered material products portfolio globally. Rising ASPs is good for specialty chemicals, and this is a beautiful looking bull flag. And just to remind you all, anybody that's listening to this, that this is exactly also what we discussed 2 weeks ago on October 1st in the conversations that morning, where Chronicle pointed out that reiterated the bull case essentially for Celanese along with other specialty chemicals such as Westlake Chemicals, with demand curve rising rapidly from China. So demand is rising, ASPs is rising, and stock is strong. What's not to like, right?
Agreed.
All right. Yeah. With that said, what's up, buddy?
Today I have Manhattan Associates. So way back on July 7th, I talked about the company with a long-term bullish view, symbol MANH, with the overall takeaway that any dips in this stock should be bought. To quickly refresh, this is a growth play on e-commerce and logistics. The company provides software solutions for supply chain and omni-channel operations. The platforms cater to everything from warehousing, point of sale, transportation, order management, CRM. The bull case I introduced back then was that the company recently introduced the world's first cloud-native enterprise warehouse management system covering every stage of distribution. From the warehouse perspective, the offering will never need upgrading, and it comes with machine learning with respect to machinery and warehouse robots, as well as AI-enabled prediction model order streaming. And this is all scalable and tailored towards client needs, whether it's a behemoth like Walmart or Target, or it's for SMEs. So that's the recap. Yesterday, Truist was out with a note raising their price target to $120, while raising 2021 estimates and introducing 2022 estimates. Basically, they have channel checks confirming what I had anticipated about this new offering. Just to take a quote from this note, the analyst wrote the following, quote, data points from a wide variety of industry contexts point to growing momentum with Manhattan's cloud product strategy. Since the company launched its cloud-native WMS product, we are impressed with the level of engagement with existing customers as well as brands not currently customers. We believe e-commerce is driving significant increase in discussions industry-wide around either upgrading existing solutions or investing in best-of-breed cloud WMS for the first time. We are bullish on a potentially strong adoption curve for Manhattan Associates cloud native WMS over the next 3 to 5 years. Additionally, e-commerce and supply chain transformation conversations seem to be picking up across the industry, and we believe demand is likely to be improving to relatively strong for TMS, OMS, and Manhattan Active Omni Cloud solutions. As we have heard from both smaller and large global brands, the acceleration of e-commerce trends and required investments seems to have quickened by 2 to 3 years in some cases, end quote. Now, looking at their financial modeling, they're forecasting roughly low teens compounded revenue growth over the next 2 years and impressively 40% growth in free cash flow. In terms of profitability, this company has 18% return on assets, 36% on capital, and a 50% return on equity with 53% gross margins. So that free cash flow prediction looks realistic to me. They also have zero debt. Their business model is pretty simple to understand. Cash flow is easy to predict. And so I think this is a safe bet over the next 2 years.
Yeah, excellent stuff over there. And just a reminder to everybody that this was covered also in the conversations video back on July 7th. And that's when the positive secular bull case in favor of the company was discussed. That was right over here, July 7th, sometime over here. The stock went up slightly in the days following and then went into a consolidation period between 90 and 100. And only recently, in the last couple of days or so, it has started to break out. $100 was the resistance, became support. We retested that support yesterday as the market was pulling back and ended up finishing strong with a bullish engulfing candle, currently at 104. I believe this trend will continue with higher highs and higher lows. Looking at technically, MACD is lifting higher. RSI has been rather very strong. Should easily get to $110 to $115 range. And we should expect a strong quarter when the company reports next week on October 22nd. So I like it. Very impressive long-term and short-term bull case for this one that we have covered multiple times now. Great stuff, as usual, gents. And that's it from us. We'll see you in the chat room shortly.